This is always a pleasure to work with you and the people over there at Investor Inspiration. And I can see all the people from all over the world. Wow, this is exciting. I love this. Man, back in the days of old, if I wanted to go hear a lot of great speakers like we are today, have to travel somewhere where all the speakers would come together. And now we've got this amazing technology where you can sit in the comfort of your home or office and hear all of these wonderful traders. So welcome, everybody, and thanks for having me. All right, so my topic today, as you can see from the slide there, is a little bit about Fibonacci. Now, Fibonacci is a very popular topic, I know, from having, well, done a lot of surveys of literally tens of thousands of traders. And a lot of people are familiar with Fibonacci retracements. So I'm going to go beyond that today. We'll talk a little bit about that just to make sure that we get everybody up to speed. And even if you're a beginner and you don't even know how to pronounce the word Fibonacci, that's okay. I'll get you up to speed with the rest of us, and then we'll go from there and give you some little more advanced stuff. You guys want some more advanced stuff today? All right, and this is the kind of stuff that is really powerful, really effective, and actually works because it does go beyond what most people use. And that is pretty much the definition of having an edge in trading, is using things that most people don't. It gives you something different, something you'll see on your chart, which the person on the other side of your trade doesn't see. So let's jump right into it. So first of all, there are a lot of different types of, well, this fits into the broader category of market geometry. So you can talk about Dartley patterns, astrology, squares. In this particular webinar, we're going to focus on these ratios. Now, let me bring up my little red spotlight here. So in the header of the slide, you can see these numbers up here. And these numbers are the actual Fibonacci numbers. Fibonacci numbers are a sequence of numbers. But most people don't use those. Some do. Gann especially is very well known for using those, and you can. I know some people even set their time intervals to some of these numbers, thinking that they give an advantage. But today we're going to talk about the Fibonacci ratios, and here they are. If you want to write them down or take a screen capture of that, you're fine. You'll see these numbers throughout the presentation, so if you don't catch them on this slide, no problemo. And here's how they are generally used. The most popular usage of these Fibonacci ratios is what we call Fibonacci retracements. And it's a pretty darn simple concept. So we take an impulse move, for example, from this major high to that major low. And then we're going to draw Fibonacci ratios, meaning the percentage of the move that the market retraces back toward the origin of that impulse move. So if we go from here to here, and we retraced all the way back up to the origin of the move, we would retrace 100%, obviously. But if we retrace to this level, it'd be 23.6%, 38.2, 50, 61.8, 76.4, and those are the ratios. And we're using these as support resistance. So they really fit into the big category of support and resistance. If you wanted to categorize the Fibonacci levels, that's what it would be. Fibonacci would fit into the energy of support and resistance zones. So do they work, quote unquote? I get that question all the time is, do they work? Well, they do for what they are meant to do. And that's what they're meant to do, is to provide support resistance. So it comes back up here. And now, first of all, I like to be very realistic about this stuff, okay? With me, I'm a very, very realistic, well, because I trade real money in real time every day. So you got to say, okay, well, look at this, 23.6. So as it moved back up here, did this level work? Well, in a way, we could say no, right? We could say no, because the market didn't stop there. It went through it, went right through it north. So at this time, that level did not work. Now, at this level and at that time, it did work, 50%. So my point is, and we're going to bring this more out in the future, do these levels work? Sometimes they do, sometimes they don't. All right, and that's just the honest, transparent truth. So we're going to answer the question today as to how do we determine when they work, because Fibonacci levels are not about when, they are about where. What do I mean about that? Why we don't hear too many people talk about that. Let me do this. I wasn't even planning on doing this, but this is so important. So you've got two axes on a chart, right? This is your y-axis over here, and that's price, and that's where Fibonacci comes in. So that is a where issue. Where on the price axes. Now this down here is your time axis, right? And this is when. And W.D. Gann said that trading was all about the confluence of time and price, and that's the key. So Fibonacci retracements do not help you with time. They don't help you with this axis. So they give you potential price levels for support resistance, but they only provide half the equation. And we'll talk about the other half of the equation before we're done today, because you got to have both. Okay, so it comes up, and at this time, 50 works. Down here, 23.6 works. Who says that? Michael, right? Very good, Michael. And we're twice, actually, for support. Yep, that's right. This time it came up here, 61.8 worked. Okay. And so, yeah, these levels do work, but of course, the million-dollar question is, when is it going to work this time? But that's the basic concept. Now let's look at Fibonacci retracements. And we'll get to how to use the confluence of time and price here in a moment. Now with Fibonacci retracements, or extensions, we used retracements before. And retracements are usually used for entries in continuation of a trend. Now extensions is a 3-point drawing tool. These are drawing tools that you can find on your charting platform. And I'm using NinjaTrader here, but pretty much all trading platforms have these that I've seen. So what we did in the last one for retracements is you just draw from here to here, and then we're looking for levels above there to find resistance, generally to go short, okay? But with this, with extensions, that's not what we're looking for, because now we're looking for, okay, and this is, by the way, very important in today's stock market. This actually comes into play right now, historically, today. Very, very important. And we're looking for, when we get down here, what about levels below this? So it's a 3-point drawing tool. You have to click here, and then click here. And then you can see that it draws these ratios below that high, and then below that low. So the reason I say that this comes in today is that the stock market's making all-time highs. So we don't have any previous history to go back and to say, oh, we've got a resistance at this particular high in the stock market that we need to be watching. What happens when you get certain stocks that are reaching all-time highs and you're looking for profit targets if you're long? Well, this is one way to find profit targets, resistance levels, or conversely, support levels in a trend where there's not any historical significant levels in recent history. And so for that reason, this is one of the most powerful tools for profit taking. So, okay, boom, there you go. Same ratios, by the way, same numbers. And again, you can see, do they work? Well, yeah, but did 23 work here? It kind of paused. What really was our pivot level here, our swing level was at 76.4, and then again at 38.2. And then it goes down to 100%, then comes all the way back. Now this time, 23 does work, and then 76. All right, so again, you can see that, yeah, they work, but which one's going to work when? On this move up here, well, 76 didn't do much, 61 didn't really help us, 38 didn't help us, and so it's like, which one is going to work when? Again, your price axis. All right, keep that in mind, because we're going to answer that question for you today. Now, those are the two most common types of Fibonacci tools used. So let's, we got a question here. Michael's asking, oh, yeah, you can use this on pretty much any time interval, right? So this is time interval agnostic, if you will. Yep, good question. Okay, now what we can do, if you want to get a little fancier, getting into a little more, I won't say advanced yet, we'll get to the advanced stuff, but now we're talking about intermediate level. So for those of you who want to get into a little intermediate level, then we're going to talk about Fibonacci clusters. So we'll take the first two tools we already learned, and that is we've got our impulse move from there to there. And then here is our retrace levels. Then we're also going to add on top of this our Fibonacci extension. So that's drawn again, start with the same low to a high and then to that low, because we've got this swing high in between there and there. And that's our 3-point drawing tool, and then it draws these levels. Now we look for clusters where these ratios come together, and that is certainly one point right there. 38.2 on the retracement, 76.4 on the extension. So these are considered stronger levels. Why? Why? I always like to answer the question why. I like to give you the reason as to why. It's not just because there's two lines on your chart, okay? The lines on your chart really don't mean anything. Lines don't stop price. Those bars don't really mean much of anything in real life. They are maps. Technical analysis, this is my own definition, technical analysis is the map of mass psychology. Don't think the indicators or the lines or the bars are actually doing anything. They're not doing anything. They're historically mapping what's going on behind the scenes. As Renee said, I was at the Chicago Mercantile Exchange, got my education there. So I was down on the floor, saw what's going on in the pits. That's the real market. Okay, that computerized trading, algo trading, high frequency trading, all that stuff's happening behind the scenes, and charts just map that activity. So what's going on, the reason that clusters work is that, and by the way, you can use clusters with other tools as well. So you could use Fibonacci clusters with, or you could use Fibonacci with floor trader levels, floor trader pivots. You could use it with previous swing highs and lows, any other type of support resistance. Where you'll see clusters, why that is significant is that you will have one group of market participants looking at one support level, and then another group of market participants in this worldwide global investment environment looking at another support resistance level. So if those two levels, based on two different techniques and mathematical principles, are near the same place, you're going to have more market participants seeing it, buying off of it, selling into it, taking profits into it, reacting to it. Basically, it's, yes, a self-fulfilling prophecy. Now, it's funny because when I share this, a lot of times people say, oh, well, that's just a self-fulfilling prophecy. And I say, really? How do you think the markets work? What do you mean, just a self-fulfilling prophecy? That's what the market's all about. The markets are an auction place. And people are always looking, what are other people doing? How high are they bidding? What are they willing to pay? All that kind of stuff. And so, yeah, it's not just that it's an auction place. It's not just a self-fulfilling prophecy. That's what makes the market go round. So this is the logical reason that clusters, whether you measure them this way or another way, actually do work. And by the way, anytime people tell you to, you know, here's a trading idea, if there's a trading idea, great, listen to it all. But always ask, what's the market logic behind it? Why does that work? And if someone doesn't have a reason as to why it works, I mean a logical reason based on market auction theory, well, I would just toss it. I would toss it because there's no sound reason for it. Okay, so anyway, you get the idea. That is the idea of clusters. All right, now let's get into some more of the advanced stuff. So now, the Fibonacci time extensions. All right, we talked about the price and time confluence, right? So we've been using price action so far on Fibonacci price tools. So now let's use a time tool. Yep, Fibonacci actually does have a timing tool. So here's one called the Fibonacci time extension. So now the principles are the same. We start with a low and we go to a high. So there's your impulse move. Zing. Now, instead of drawing horizontal lines, which measures price, it measures vertical lines, measuring time. And so now the cool thing about this is, now we can see at what time we can expect the market to put in swings, highs and lows. Now, this is an extension tool. So similar to the price extension, this is a time extension, meaning that it's going to give us levels beyond the high instead of back here. So now the numbers are going to be greater than 100, right? Because they're going to be 123. The ratios are still the same. You just add a 1 before them. They're all going to be over 100%. So sure enough, we put in a low there. The market just kind of goes sideways here. And then as soon as it gets into that zone, boop, goes up. Pretty cool. Now, another thing on these levels relating to what I already said. So we've got these Fibonacci time extension lines. But as I said, these are just basically maps. And so don't get too enamored with being real precise on the line, because the market's not that neat and tidy. Markets are, well, they're made up of people, and people are not real neat and tidy. People are kind of messy. We're messy as human beings. Plus, not only that as individuals, but then again, you've got masses of people from all over the world trading this stuff on different exchanges, different countries, different currencies, using different techniques and different time intervals. So you've got to allow for a little bit of leeway at the swing highs and lows. So you got a line, but don't worry about it. You know, we can get real myopic on this stuff with our charts, looking at, okay, where's the exact pixel where that line comes in? All right. No. That's not going to be helpful at all. In fact, that's going to really mess you up. So think of these lines as zones. In fact, all support resistance levels are zones, not lines. Really encourage you not to even use the term lines, just for your own mental sanity, frankly, so that you don't get, again, too myopic about it. So think of it, okay, we're coming into this zone. So somewhere here, a little bit to the left of it, a little bit to the right of it, maybe right on it. Every once in a while, it happens to nail it. But in this zone, I'm looking for a shift, a swing high, a swing low. And so great, we get one. And we get one here. Again, notice it's within a bar. Here again, within a bar. Here again, within a bar. Now again, let's be realistic. Because sure, that's all great. But as you look at the chart, did this high here come in at a Fibonacci time extension? Nope, it did not. What about this low? Did that come in at a Fibonacci time extension? No. So point is that just like with the horizontal lines, the price Fibonacci levels, these aren't going to nail every single high and low. They'll catch some of them, but not all of them. And that's okay. That is perfectly fine. I find so many traders are, for some reason, they're always wanting to be right. In other words, in the trading community, when we talk about people wanting to be right, it's like they think they need to catch every move in the market. Well, that's impossible. Never going to happen, right? Because, I mean, just an obvious example is news can come out, and there's no technical analysis that's going to predict, you know, what news is going to come out in the next 5 minutes, half hour, tomorrow, June 13th, whatever. So, and it might not even be real news, right? It could be gossip, or it could be a rumor that just boom, springs into the market, comes across the news wires, and it just boom, catches everybody by surprise. Well, no indicator or Fibonacci level or anything is going to predict that that's going to happen. These things are not crystal balls. They're just market geometry based on the rhythm of basically how the human brain works is what it really is. And so it's the brain, the human being, the mass psychology of the market, the social experience of people, behavioral finance. That's what this is really all based on. People basically think in terms of thirds and quarters and halves. And so we're looking for basically those zones that people normally react to. And so this stuff works great for that. But understand, there's going to be plenty of other stuff that goes on in the market, and you don't have to catch every move. In fact, you won't. So get that realistic expectation right now. And if the market moves, here's a common experience that I see people having. They're like, dang, I missed this big move. How could I have caught it? And that question can be okay. it's not bad to analyze that and say, is there a consistent pattern here? And if there is, great, you might learn something new that you can use in your trading in the future. But don't think that there's always going to be consistent pattern based on one move in the market. There may not be. It may have just been an outlier. It may have just been a random event. And so if you can't find a pattern, just let it go. Look for something else that is more common, that is more repeatable. And we're here to make money. So that's the difference. We're here to make money, not to be right. We don't have to catch every move. We just have to catch a few. And these levels, if you can catch moves at these levels, great, you're golden. You're making some money, honey, right? That's sweet. That's really all we need to do. We don't need to prove to everybody, oh, I catch every move in the market. No one's going to believe you anyway. So, okay, now here's a really cool tool. This is one of my very, very favorites. And I'm going to give you an insight to this one that a lot of people don't tell you. And if you don't know this little trick, it will mess you up with this tool royally. So one of my favorite tools is the Fibonacci. Well, it can be called different names. So let me give you a couple different names for it, depending on your charting software. Some call it Fibonacci circles. Some call it arcs. Both are right. Technically, it really is forming a circle, a 360-degree circle. But the reason that some charting platforms call it an arc is because the visible area of the screen will only show an arc. So as you can see there and there, it looks like an arc. Now, if I were to change the scaling here and I were to pull it way out, look at it from a bird's eye view, and I had enough historical data here, it actually would be a 360-degree circle. But the part we're only going to trade as the future is these arcs. All right. Now, what's cool about this one is it actually combines both time and price into one drawing tool. So you could put your Fibonacci retracement extensions on there to measure price levels. You could put your Fibonacci time extensions on there to measure time, look for the confluence of them. And that's totally cool. This one, you just need one tool to get both. So again, we use our impulse move. Again, the principle is the same to start out. So from a major high to a major low. All right, and then this thing kind of curves up. Notice as time goes by, the price level changes. As the price level changes, the time changes. So they use both at the same time. Now, as the, get my spotlight up here. So as this thing goes up, the market rides it up and then boom, comes back down. Goes to the next one. When it hits the next one, boom, comes on down. That's the time and price to look for a swing high. The time and the price to look for a swing high. Again, in the spirit of transparency, did it catch this low? No. Is that a huge problem? No, no problem. I made money here, made money here. That's all I need to do is make some money. So, oh, the one extra tip, yes, oh, this is very important. So here's where a lot of people mess up using this tool, is that they say, okay, I'll draw this tool on my chart and I'm golden. You're not quite golden yet. There's a trick to drawing this tool. You must use a fixed scale on your chart. And if you don't use a fixed scale on your chart, what happens is that these arcs, these curved lines, will actually move as new price bars are formed. Yeah, they'll move. And so you'll look a little later and as price goes on, let's say 10 bars later, and this curved line, this arc, is no longer there. It might be back here. And you'll say, wait, I thought that caught that high, but now it didn't. Was I mistaken? Is my brain falling out? Am I forgetting this? I'm getting old. Oh no, had a senior moment. No, you didn't have a senior moment. The problem is that you've got to have a fixed scale, meaning, now in NinjaTrader, I can tell you how to do it. Others, I don't know necessarily. But in NinjaTrader, what you do is you just take your cursor, put it here into the price axis, click on the left button, and all you have to do is move it down or up a little bit and then let go, just a little bit. And what that'll do is it'll make sure that the spacing between the prices here remains constant. Whereas otherwise, what happens is if the price bars go above this high, usually it'll auto scale. and then it'll squeeze these numbers together so that the price stays visible on the chart. You don't want that. You can't have that for this tool at least, because then it messes up the scaling and these lines will move from their original position. And so that's where a lot of people I see who try this tool and then later come back and say, you know, it really didn't work very well. I asked them about this and they like, I don't even know how to fix the scale on my chart. Like, well, contact your software provider to find out, or if you have one that I use, I can tell you. All right, so muy importante. Okay, where are we here? Let's get to the next one. So now let's talk about how to put this all together, because as we've seen, not every one of these levels work, whether it's a price level or a time zone. Some will, some don't. So which ones will work at this time? This time meaning the time you're entering a trade. So this is where Fibonacci levels become just part of an entire trading methodology. You cannot trade these levels by themselves. They are not a complete money-making tool. They are a tool in your toolbox that can be used as part of the blueprint, if you will, of a money-making methodology. But they're just one tool. They're a good tool, but you gotta have other tools. In other words, trading is about creating a probability scenario that favors you. And one variable, by definition, does not create a probability scenario. This is only one variable. It's a good one, but we need more. So here's how I create a profitable trading methodology using Fibonacci. What I do is I use 5 energies. When I refer to energy, I'm talking about the energy of money. Money flowing in, money flowing out. The energy of money flow, if you will. And I measure it in 5 non-correlated ways. And here's my little list. I'll just give you my list. This is literally my entire 5-step checklist for making money in the market. And these non-correlated energies are what I look at. So number 1, I look for trend. And this, again, it's literally a checklist. And I start at the top and I go to the bottom. That's all I do on every single trade. What's the trend, up or down? What's the momentum? Is it a strong trend or a weak trend? What's the cycle? There's your timing. This cycle indicator actually will catch every single cycle high and low, every single one. And I'll be happy to give that to you for free. Now, number 4 is support resistance. This is where Fibonacci fits into the toolbox. It is energy number 4. And you can use also other support resistance levels, floor trader pivots, 52-week highs and lows, all that kind of stuff. These first 4 are in the short-term chart. Then if these are all bullish or all bearish, then I go to the next higher time frame. I call that my fractal energy. And I just make sure that it is, well, the dominant energy is how I like to say it. The dominant energy of the longer term time frame is in the same direction as the alignment of the 4 energies on the short term chart. So if these are all bullish, the dominant energy on my longer term chart must be bullish as well. If it is bearish, that is, well, that holds veto power. That's a filter to keep me out of an otherwise good-looking trade. If you ever had good-looking trades on a chart and it doesn't work out, well, the way I get out of that is I look at the next higher time frame, make sure that momentum right here, this is the energy I use on the long-term time frame. I don't use trend personally. I like to use momentum on the higher time frame to make sure that it's bullish as well, or conversely bearish if we get a short. So as I said, I use this to determine a probability scenario. I ask myself at any one particular point when I'm looking to enter, how many of those energies are aligned? I give it a score of 1 to 5. The higher the score, the higher the probability of success. I liken this to taking each trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. So let's look at these 5 energies here real quick, give you a little more detail in each one. And by the way, I don't use any proprietary indicators. I use all just very common indicators. They're in every trading platform out there. There's a lot of cool stuff out there, believe me, but I've just kind of come full circle and found this is all that I need. This is enough for me. So for trend, I just use the 50-period simple moving average. Gives the overall direction of the market. Some people will say that trend is higher highs and higher lows. That is a half-truth, but really the dictionary definition of trend is this: to extend in a general direction. Now think about that, a higher low. Like for example, here we have a lower high and a lower low. So are we in a downtrend here? The answer would be no, we are not. That is not enough to define a trend. A trend is a long-term move to extend in a general direction. So that means it's a long-term move. Now, I'm not just trying to be a stickler of the English language here. This actually has financial implications. We want to make sure that we have a very low risk and a very high reward. So that's also another reason why it's important to define trend as a long-term move, so we get big rewards. All right, so this is just a little like ABC complex retrace. The 50 MA, that's your long-term direction. And that's the direction we want to trade in to get a good reward. So that's direction. Now, number 2 is momentum. Momentum is the strength of the market. Have you ever gotten into well, let me ask it this way. Does it happen to you fairly frequently where you can see the market going up and up and up and up and up, and it'll keep going up until you get in? And dagnabbit, it just seems like whenever you get in, well, that's when the trend ends. How many of you have had that? Go ahead, type that into the question box if that happens to you more frequently than you would like. I mean, it happens to us all once in a while, but does it happen to you so often that you almost start to get like a little paranoid over it? I mean, I've had people tell me, come up with conspiracy theories. They say, oh, I think my broker is trading against my individual account, because it's uncanny how often I get stopped out. It's like it's impossible to get stopped out this much if trading is just objective. But no, someone's got to be on the other side of my trade. Maybe it's the market makers who know where my stops are. They can see my stops, and so they're taking out my stops. Okay, here's the problem. Brokers don't really care that much about your account, and I'm not trying to diminish your importance in the planet, but they don't care about my account either. So, okay, they're not focused on you or me. They got bigger pictures in mind, right? Much bigger money. What's happening is, and this is such a common problem among beginning traders, is really this: trading against the dominant energy of the market. There's that phrase again, dominant energy of the market. When I refer to that, I'm really talking about momentum, strength. But most people have never learned how to determine a strong trend from a weak trend. And this is the pivot right here. This is the pivot. Are you trading a trend, not just a trend, but a strong trend? Because if you're trading a weak trend, that's when you get stopped out. So we need some sort of an indication of that. So here, for example, is the momentum indicator that I use. Look, we get a higher high, higher low, higher high, higher low, higher high, 50 MAs angling up. Okay, so we could say, well, look at momentum though. Moves up, so this higher high, or was this, sorry, this higher high, momentum is way up. Great, so this trend right now is strong. Has strength behind it, momentum. At this higher low, still, momentum is way up. Now, here we get a little bit of a warning sign, a little shot over the bow, if you will, because momentum is an equal high. So it's moved up, but not with strength. Then at the next slightly higher high, momentum has actually moved down. We've got a divergence there. So now, yeah, price is still moving up, but with weakness. So momentum is a potential leading indicator. In fact, that's really the only potential leading indicator that I'm aware of. So that means, yeah, price is still going up, but on weakness. Now, what does momentum literally mean? Momentum is mathematically defined. Again, I like to explain the logic behind everything. In physics, it's defined as what? Who knows the mathematical definition of momentum in physics? Let's see if we have any geniuses here, mathematical geniuses, any PhDs in mathematics from MIT or Harvard. What is the mathematical formula for momentum? The first one who guesses it gets an invisible Cupid doll from Top Dog Trading the day after I die. Go ahead and type it in. It's not a rhetorical question. Let's see. No geniuses? Oh my gosh. I think we have a little latency issue here too. There we go. Yay. Okay. Yep. I think we just have a little latency issue because now we got a bunch of answers coming in. Okay. So thank you, Bjorn, Michael, Ram, Harry. Good. So you guys do know. So velocity times mass. Velocity times mass. So think of it this way in trading. Velocity for momentum is the speed of the orders coming in. When I was in Chicago, we could see people rush into the pits, placing orders really fast, yelling, screaming, trying to get their orders in before everybody else. Mass equates to volume. So we'd see the big orders coming in. It wasn't just the guys who were bartending at night and trying to become floor traders during the day. No, it was Merrill Lynch, Goldman Sachs, Citibank, those guys. They were coming in with their big orders. When you get those big orders coming in fast, that's momentum. All right. And that's going to be sustained because they tend to come in based on the principle of accumulation so that they don't drive the price of the market up too fast because they want to keep getting their orders in at lowest prices they can. So now you're getting the opposite here. You're getting price going up, but on retail buying, amateur buying. Merrill has left the pit. Goldman no longer buying, right? The bartenders are buying here. So we can see this. The easier thing to do than to have to go all the way to Chicago, and most of the pits are closed now anyway. But this maps, again, technical analysis being the map of mass psychology, this maps the action behind the scenes. Now, if you're just a pure price action trader, you still got higher highs and higher lows. But this gives you kind of an inside scoop, a sneak peek on what's going on behind the scenes. And so this is a weaker trend. By the way, it's not just the highs. A lot of people teach these divergences, and that's cool. I prefer, and that's good, I look at that too, but I like to look at the lows, right? This is an uptrend. So if I'm thinking of buying here, I say, okay, I've got a higher high and a higher low. But wait a minute, what happened to momentum at this low where I'm thinking of buying? It's way down, way down. So don't just look at the highs, look at these lows too. No bueno, not so much. And so I'm actually going to say, you know what, at this point, I'm not going to buy that, but I'll probably short that. Why? Momentum shift. The strength of the market has shifted. You can even see this sometimes in sideways markets where there's an equal high here. And this is one of the great ways. How do I trade channels? How do I trade channel breakouts? I don't wait for the breakout. Okay, waiting for the breakout, that's late. That's paying retail. I want to buy wholesale. So I trade inside the channel, buy or short at the high, and I look for these little momentum shift patterns. Yes, see what other people don't see. Again, that's your edge. Energy number 3 is cycles. And I'm going to give you guys my cycle indicator, by the way. It's just a modification of an indicator already in your chart. But the basic idea, let's see, I got 7 minutes left, so I got to speed it up here a little bit. Cycles are the rhythm of the market. So this refers to timing again. This time, that time, this time, that time, this time, this axis down here, the x-axis. And this is important. You've got to have some sort of accurate, precise timing tool on your charts. Otherwise, you're missing out on 50% of the information on your two-dimensional object called a chart. How can you have a probability scenario if you're missing out on 50% of the information? I mean, by definition, mathematically, you can't. And W.D. Gann said, really, of the two, time is more important than price. And number 4, as we talked about, support resistance, Fibonacci, boom, there's your impulse move. Here's your retrace. 23 didn't do it. It ended up being 50. But look what happened. When we put it all together, see the other example I showed you, we didn't have all this stuff on there. Now we do. So now we see, oh, why did this level hold when 23 didn't? Well, we've got a cluster that high in 50%, so previous major swing high. We got a nice candlestick topping pattern. This is where your candlestick bars come in. Even Steve Nissen, who brought candlesticks to the West, said, do not use candlesticks in isolation. No one thing works in isolation, but it's a great tool to use with the other tools in your toolbox. So in this case, we say, yeah, we're at a cluster of resistance. We got a nice topping candlestick pattern. Trend is down. 50 MA is down. By the way, this is the trade setup I'm going to give you guys today as a free gift called the rubber band trade. And the basic structure is price being above a downward angling 50 MA. And we take that short. So I'll give you all the details, the rules, the filters, and all that stuff in my free course I'm going to give you today. So that is then coming in at a time when the market puts in a cycle high and on very low momentum. See here, big momentum to the downside. Here, very little momentum to the upside. What's it take to break through resistance? Strength, momentum. We don't have it here. And then the fractal energy, finally, is the longer time frame. I like to use a 3-to-1 ratio. You can use other ratios if you'd like. Maybe a 1, I use 1-to-3, 1-to-4 is fine, even 1-to-5 is okay. But here's the bottom line. We get a downtrend here, retrace cycle high, goes back to, there's your 50 MA, that's the 15 EMA, that's our resistance level at this point. Cycle puts in high here, momentum is down, it's below 0. And guess what? Momentum is down on the longer term time frame. And I prefer to use momentum instead of trend on the longer term time frame because it indicates not only direction, but strength of that direction. So think about it. If you've got bearish strength concurrently on 2 time frames, then that market is more likely to really take off to the downside. And I like that. I like my P&L to go up fast, not slow. So we're just about out of time, so let me just finish up. And actually, this last slide will answer some of the questions I've seen out of the corner of my eye here. Yeah, this method does work for all markets and all time frames. I trade this on stocks, commodities, options, currencies, futures. And I do it with investing, swing trading, and day trading. So because you're just really taking data from whatever market you put on the chart relative to whatever time frame, and that's the data that's going into your indicator, into your drawing tools. And so they're already predisposed to measure that. And that's simple, it's objective in my method. You're only counting to 5. We can all do that. But again, what makes it strategically powerful is that these 5 energies are not correlated. So here's my freebie for you today. Actually, I didn't bring anything to sell, so I kind of dropped the ball there. Sorry about that. I know you're all bumming out right now because like, wait a minute, Barry was supposed to sell us something. I know, I was. I forgot. So I hope you don't mind too bad. But anyway, I do have some freebies for you, and they're good ones too. I'm going to put my email in here real quick. Let's see here, where we go. There we go. Okay, so you can contact me, and feel free to contact me anytime you want. I love talking with traders. Never feel that you're going to be bothering me. That would be impossible. I love communicating with traders. It is one of my very favorite things to do in the world. Every day I get on my email at night before I go to bed and talk with traders, and that's fun. So here are my freebies for you. My free course, How to Make Money by Breaking Every Trading Rule You Ever Learned. How's that for controversial? Here's what you get with it: 5 20-minute video tutorials. And these are basically traditional rules in classic technical analysis that used to work that no longer work. And then how to use new rules to replace the old ones that work in today's markets that have high frequency trading, algo trading, commoditization of retail trading, low commissions. All this stuff has changed the way markets move. So chart patterns are not the same as they used to be with the advent of technology. And so the old stuff, hey, I respect it. It was great in its day. It's just the market's changed. And so you got to have new technical analysis for the way markets move today. And that's what this gives you. So in these 5 videos, you'll learn how to use that. And then each video comes with an interactive quiz at the end, so you can make sure you got it. As I mentioned, not only is it going to be theory, but it will also give you a trade strategy called the rubber band trade you can actually use to start making some money. So that's what I like to do. Before people get my courses, I like you to buy my courses with money I've already made you. How's that? Is that fair enough? So this rubber band trade is amazing. It really works. I still use it every single day. Every time it sets up, I take it. It's that reliable. That's actually one of the reasons I give it away. It's the highest win-loss ratio trade I've ever seen. But obviously trade it on a demo account or a simulator first. Make sure you got it. Make sure you got it working for you before you put any real money into it. And then I do have a follow-up webinar where I will give you the cycle indicator that I mentioned. And what we do there, again, super simple, nothing to download. It's not proprietary. It's actually an indicator already in your charts we modify. And then I take about 30 minutes to show you how to trade it, because it's not really intuitive how to trade it. It's actually counterintuitive how to trade it, which is actually a good thing because it means most people won't do it. So I'll teach you how to do it. Once you know it, it's simple. And this really nails every single cycle high and low. And there's the URL. It's posted into both the chat box and to the question box. And my gift to you.